Ever wondered if gold could be your key to financial stability? Let's delve into the intriguing world of gold investment. Gold, the shimmering metal that has captivated humanity for millennia, isn't just a symbol of wealth and power, it's also a unique and compelling investment opportunity. Unlike ordinary coins or paper currency, gold has an uncanny ability to retain its value over centuries. This is due to its unique physical properties that have made it highly prized throughout history. Gold is resistant to corrosion, which means it can endure where other assets falter. Its lustrous beauty doesn't fade with time, just like its worth. Gold's ability to maintain its value isn't just a historical phenomenon, it's a fact that has been tested and proven time and time again. In moments of economic instability, when other assets are depreciating, gold often stands firm, or even appreciates. This has led to its reputation as a safe haven, a place where investors can park their assets when times are uncertain. But it's not just about safety. Gold is also an asset that can be liquidated, melted down and converted into cash, at virtually any time. This gives it a flexibility that many other forms of investment lack. Gold's enduring value and unique properties make it a compelling option for investors looking for a long-term store of wealth. It's a tangible asset that you can hold in your hand, and yet it's also a part of the financial system, traded on markets around the world. However, the world of gold investment is not without its risks. Like any investment, it's important to understand what you're getting into. While gold has a long history of maintaining its value, it's not immune to fluctuations in the global economy. So whether you're an experienced investor looking for a new opportunity, or a novice exploring the world of finance, gold offers a fascinating and potentially rewarding path. It's an asset that has stood the test of time, a testament to its enduring allure and value. Gold, a timeless asset, has proven its worth throughout history, but how does it fare in today's economic landscape? As we navigate the complexities of modern finance, let's continue to explore the captivating world of gold investment. In an era of rising inflation, can gold safeguard your wealth? Let's delve into the enticing alchemy of gold and inflation. Unlike your regular coins and paper money or other types of assets, gold has been known to preserve its value over centuries. This unique physical attribute of gold, which is resistant to corrosion and can be melted down, is highly valued. Now let's talk about inflation. Inflation is like a silent thief, stealthily reducing the purchasing power of your money over time. As the cost of goods and services increase, the value of your money decreases. But here's where the magic of gold comes in. When inflation is on the rise, the price of gold tends to soar even higher. Why does this happen, you might wonder? Well, as investors see their money losing value, they seek assets that maintain or increase in value over time. Gold, with its centuries-long history of preserving its worth, becomes an attractive alternative. This is why gold is often seen as a hedge against inflation. But wait, it's not just about inflation. Gold also shines during times of economic uncertainty or instability. If the economy takes a tumble, or geopolitics get shaky, investors often flock to gold as a safe haven investment. So, while paper currencies are vulnerable to the whims of inflation and economic downturns, gold can offer a level of stability. In essence, the value of gold tends to move in the opposite direction of the economy. When the economy is down, gold is up, and vice versa. But it's also important to remember that, like any investment, gold comes with its own set of risks. The price of gold is influenced by international markets, decisions by various global organizations, and the exchange rate of the US dollar. So, while paper money loses its purchasing power, gold shines brighter. But does it make for a good portfolio mix? In our next scene, we'll explore how adding a little sparkle of gold can diversify your investment portfolio. Scene script: is putting all your eggs in one basket a wise decision? Likely not. As the old saying goes, don't put all your eggs in one basket. This wisdom rings especially true when it comes to investing. Diversification, or spreading your investments across a variety of assets, is a time-tested strategy to reduce risk and potentially increase returns. Now, imagine your investment portfolio as a basket. It might contain stocks, bonds, real estate, and cash. But what about gold? Yes, gold. That shiny, precious metal that's been a symbol of wealth for centuries. Well, gold can be a valuable addition to your investment basket, serving as an effective diversifier. You see, the price movement of gold often behaves in a way that's contrary to the stock market. So, when stocks take a nosedive, gold prices tend to rise. This inverse relationship between gold and stocks can provide a safety net during market downturns. It's like an insurance policy for your portfolio, helping to cushion the blow when things get tough. But why does gold behave this way? It's because gold is viewed as a safe haven asset. When economic conditions become uncertain, investors often flock to gold. It's like a financial refuge, providing stability and security in times of economic turmoil. Now, this doesn't mean you should convert all your money into gold. Remember, diversification is all about balance. The goal is to have a mix of investments that work well together, complementing each other's strengths and weaknesses. Adding a sprinkle of gold to your investment basket can provide that balance. It can offer a layer of protection when stock markets are shaky, and it can contribute to potential returns when gold prices rise. Diversification is key in investment, and gold seems to fit the bill. But is it a liquid asset? Well, that's a question for our next scene. Stay tuned as we delve into the liquidity of gold and discover why it's not just its shine that makes it a valuable asset. Scene script. Need cash urgently. Can gold come to your rescue? In the world of investments, liquidity refers to how quickly an asset can be converted into cash without affecting its market price. And when it comes to liquidity, gold shines bright. The liquidity of gold is one of its most attractive features. This precious metal can be cashed in at any time, anywhere in the world. Imagine you're an investor who has put your money in various asset classes. In a cash crunch, which asset would you turn to first? Real estate, stocks, bonds, or gold? While real estate might take months to sell, and stocks or bonds might be vulnerable to market volatility, gold can be sold immediately, offering a much-needed financial lifeline. Gold is universally accepted and its value is recognized globally. This means that regardless of where you are, you can convert your gold into cash. The process is as simple as walking into a gold dealer or jewelry shop, or even selling it online. And the best part? There's always a market for gold. Gold also provides flexibility to investors. You can choose to sell all or just a part of your gold holdings depending on your cash requirement. You don't have to worry about selling a whole property or a set number of shares. With gold, you can sell down to the last gram. Moreover, gold can also be used as collateral for loans. If you're in need of cash but don't want to sell your gold, you can simply pledge it to a financial institution and get a loan against it. However, remember that while selling gold is easy, it might not always fetch you the best price. The buyback price of gold might be less than what you paid for it, especially if you're selling it shortly after buying. Gold, with its high liquidity, seems like a reliable partner, but are there any risks involved? As with any investment, it's crucial to understand the potential risks and downsides, but we'll delve into that in the next scene. For now, remember, gold's liquidity makes it a versatile and flexible asset in any investment portfolio. Every rose has its thorns, and so does gold. As we delve into the world of gold investment, it's crucial to not overlook the potential pitfalls. Much like other investment ventures, gold is not entirely risk-free. Let's start with the risk of loss. If you're investing in physical gold, be it bars, coins, or jewelry, you're exposed to the risk of theft or misplacement. This is particularly true if the gold is stored in an insecure location. Therefore, safe storage is a consideration that should not be taken lightly. Next, we have to consider the potential for low buyback values. When you invest in gold in the form of coins or bullions, you may face a decrease in value each time you offer them for sale. This is due to the fact that the price you receive when you sell your gold, also known as the buyback price, may not be the same as the retail price at which you bought it. Dealers have to cover their overhead and make a profit, and as a result, they often offer lower buyback prices. Lastly, but certainly not least, is the risk of fluctuating prices. The price of gold is influenced by international markets and decisions made by global organizations. The exchange rate of the US dollar also plays a significant role. For instance, when the dollar strengthens against other currencies, the price of gold often drops and vice versa. This means that the return on your gold investment can be unpredictable and may not always meet your expectations. It's important to note that these risks do not negate the potential benefits of gold investment. Instead, they highlight the need for careful thought and strategic planning before diving into this investment venture. While gold shines bright, its glow isn't without shadows. As with all investments, understanding its risks is crucial. So arm yourself with knowledge, balance your portfolio, and always be prepared for the unexpected twists and turns of the investment journey.